This is video T4D on timing. In the name of timing, we're going to be quick on this one. We have covered the timing variable in previous videos. Remember Mercedes and Daniel from Module 1? What did we learn? Hopefully the general rule. Accelerate deductions and defer income. This is purely a time value of money play. We know that accelerate, defer general rule can be affected by things like a change in tax rates. Let's start with a classic timing decision. For many taxpayers, a contribution to an individual retirement account, or IRA, is deductible up to $5,500, at least in 2017. This deduction is only permitted for taxpayers that have income of less than a certain threshold. Because some taxpayers may not be able to measure their income accurately until after year end, and because Congress wants to encourage retirement savings, they permit a deduction for a contribution during the year, of course, but they also permit a deduction for a contribution made up through the filing deadline, which is typically April 15th. When a late contribution is made, or one after year end, it generally makes sense to deduct the contribution in the previous year. In fact, when you want to make a contribution at all, it makes sense to make it close to the April 15th deadline. As you can see, the after-tax cost of the contribution goes down when made after year end. However, most deductions do not enjoy the sort of delay afforded to IRA contributions. There are a number of restrictions that might apply to a taxpayer's ability to time deductions or income. First, typically, you have to pay the expense to deduct it. Obviously, if you don't have the money to pay, you can't take the deduction. Number two, you have to stay in the investment to avoid gain recognition. For example, you could be invested in a great stock that has increased in value considerably. You're ready to capture that value by selling the stock. You are not going to be able to defer the recognition of the income, however, if you sell the stock. Number three, income can be deferred, but you may need the cash. We will cover recognition rules later in this module, but a cash basis taxpayer can avoid income recognition by not billing his or her clients. But of course, not billing means no income, but also means no cash. Alternatively, if our shareholder in the previous example decides not to sell the stock to avoid gain, the stock price and thus the value could go down as easily as it went up. Number four, the doctrine of constructive receipt does not permit a taxpayer the flexibility to turn their back on income. We'll discuss this doctrine further later in this module. Timing is one of the most commonly used tax planning techniques. The ability to accelerate, or less likely, defer deductions and accelerate or defer income is not entirely constrained under the tax law. We will see this planning variable reappear over and over throughout the course. However, this is the end of video T4D. Thanks for watching.